We are going to start with the MG products example. If you pull up in Blackboard, you will see the Excel spreadsheet that looks just like this. The only difference is you don't have the information typed into that. You can get that from the lecture notes from the ones that we did not follow in the lecture that I put up late earlier today. So basically, MG Products manufacturing gasket grills, and the information that they provided is they produced 7,000 units. They had sales of 11,000. Their selling price per unit was 250. Direct materials was 124.6. Labor was 196. Variable manufacturing overhead was 24.5. Fixed was 63. Variable for selling expenses was 88,000, and fixed administration and selling expenses were 130,000. So, what we want to do first of all is start with the variable cost of goods sold. We base this on to production. So, what we're going to do is take the direct materials of 124,600, divide it by the production of 7,000. So, my cost per unit was $17.80 for direct materials. For labor, I'm going to take the direct labor cost of 196,000 divided by my production of 7,000, and I'm going to get $28 per unit. For the variable manufacturing overhead cost per unit, I'm going to take the variable manufacturing amount of 24,500 divided by the 7,000, and I get a total of $3.50 per unit. So the total of the variable cost per unit is $49.30. So that's going to help us with the variable costing here. Well, first of all, we're going to do the sales revenues. So we did $11,000 or 11,000 units, and we charged $250 per unit. So my sales revenue is 2,750,000. Now, the variable cost and variable costing, we do all variable costs. So the first thing I'm going to do is the variable cost of goods sold. Over here, we had decided that the total cost of goods sold um, for an item is $49.30. I'm going to take the 11,000 units and multiply it by the $49.30. So I get variable cost of goods sold of $542,300. Now the variable selling expenses, I just take the amount that they gave us of $88,000, and I get the 88,000. Now, to get my contribution margin, I'm going to take the revenue minus the variable costs. And if I take that number, I get 2,119,700. Now, the next thing I'm going to take is the fixed manufacturing overhead cost of 93,000. And then I'm going to take the fixed selling and administration cost of 130,000. I'm going to back that out of my contribution margin, and I get 1,926,700 with variable costing. Now let's go down to the absorption costing. We do the same thing in regards to the cost of goods sold, but the difference with absorption costing and variable costing is in cost of goods sold, we are going to uh, include both the variable and the fixed manufacturing overhead rate. So again, the direct manufacturing or direct materials is not going to change. That's still going to be $17.80. The direct labor is not going to change. That's $28 per unit. And the variable overhead manufacturing rate is not going to change for $3.50. What I do have to figure out is the fixed manufacturing overhead cost. I'm going to take the fixed manufacturing overhead cost of 63,000, and I'm going to divide that by the 7,000 units we produced, and I get $9 per unit. So the total that in my cost of goods sold is going to be $58.30. Now, this fixed manufacturing overhead cost, that's what's going to drive the difference between the two. And we'll be talking about that here shortly. So again, my sales, that doesn't change. So I got $2,750,000. But this time I'm going to take my 11,000 units that I sold and I'm going to multiply it by the 5830 to get the cost of goods sold. And that comes up to $641,300. My gross margin is the difference between the two. And so that becomes 2,108,700. My fixed sales and fixed selling and administration costs stays the same at 130, and my variable selling costs will be 88,000. This makes my operating income. If I take it away from the 2,000,001, I get an operating income of 1,890,700. Now, you notice that here we had $11,000 in sales, but we only produced 7,000 units. So that means, of course, that we had $400 or 400. I'm sorry, 4,000 units in our our beginning inventory. So what was our beginning inventory at the beginning of the year? Well, all we need to do is take the 4,000 units and multiply it by my variable cost per unit, which is going to be 49.30. So in variable costing, I have a beginning inventory of 197,200. Now in absorption costing, I take the 5830 and multiply that by the 4,000 units, and I get 233,200. Now, why is this different? Well, again, it goes to the fixed cost. And this, in absorption costing, that's included in the cost of goods sold. And in variable costing, it is not. Now, explain why net income is higher using variable costing than absorption costing. It's because of the fixed overhead. Fixed overhead was deferred. So if you look at here, if I take the $9 and I multiply it by the amount of units that I sold, which was 11,000, in my cost and goods sold, we included $99,000 in absorption costing. Now, if you look up in variable costing, we only include 93,000. So that means my costs were lower, therefore my net income is higher. Here, my costs are higher because we had more units sold, and therefore my net income is lower. Now, if we go on down here and we kind of switch it up, and in this time we have the opposite effect, where instead of having 7,000 units produced, we're going to switch them and be 11,000 units produced. So I'm going to fill in this chart. We have 11,000 is produced. The selling price is going to stay the same. We get 124,600. We get direct labor is the same at 196. Variable manufacturing cost is 24,500. This makes my total variable costs 345,100. My fixed cost is 63,000, and my variable cost is 88,000, and my fixed administrative and selling cost is 130. Okay, so let's go up here. Well, let's determine our rates. My direct materials, I'm going to take the direct materials, and this time I'm going to divide it by the 11,000 since we're producing it. So if you notice, because we produced more, the rate went lower. Now, direct labor, I'm going to take the 196, divide it by the 11,000. So my direct labor cost is $17.82. My variable manufacturing rate is going to be 24 divided by the 11,000. I get 24,500 divided by 11,000. Okay. $2.23. And then the fixed manufacturing rate, we take the 63 and we divide it by the 11,000 and we get $5.53. Now for absorption costing, we take all four of those, and variable costing, of course, we just take the three, the variable items. Okay. So the first thing we're going to do is our sales revenues. We had sales of 7,000 units, so I'm going to take the 250 times the 7,000 units. I get 1.75 million. The variable cost per unit sold, so I'm going to take my variable cost of $31.37, multiply it by 7,000 units. I get 219,609. My variable costs or selling costs is going to be 88,000. That makes my contribution, if I back that out from 1.75 million, it becomes $1,442,030 or $1,442,391. My fixed overhead costs are 63. My fixed selling costs are 130, and that makes my operating income, of course, to be 1,249,391. Now, on absorption costing, we take the 1.75 million. This time, we're going to take it by the rate of $37.10. So I'm going to take the 37 times the 7,000 units. I get 259,700. The gross margin is the difference between the two. And so that becomes 1,490,300. My fixed selling and administrative costs are 130. The variable selling costs are 88. This makes my operating income to be the difference between these three numbers, and that is 1,272,300. Again, it's focusing on fixed costs. Now, if we look at our fixed cost per unit, if we take that times the 11,000, I get 63,000, which is what's included right here. Okay? And then if I take that times the 7,000, it's only included $40,090.90, which is included right here. So that is the reason why here our costs are lower than they are in variable costing if the units produced are greater than the units sold. So I hope this helps you understand variable costing and assumption costing a little bit better. If you have any questions, please do not hesitate to ask, and we'll see you in the next lecture. Goodbye.